Hey everyone, Mr. Terhar here with your e-learning lesson for May the 4th. Today we're going to continue our discussion on insurance, and we're going to talk about some of the types of insurance and get into some more of the details in terms of how insurance companies actually operate. So on Friday when we last met, we talked about the factors that were considered when insurance companies determined the insurability of an individual and how it was things like your health, your age, as well as your behaviors, your driving habits and things like that went into determining how insurable you were. Today we're going to start off by talking about the factors that they consider when they are evaluating a business to determine their insurability. So um, basically, where we are at with that is uh, in terms of business insurability, they're looking at things like location, the type of the business, so what the business actually does, the products handled or the services offered, depending on the value of those things, and then the age and condition of the property as well. So let's talk about the different types of insurance that exist. So the primary categories of insurance are life insurance, health insurance, property insurance, and casualty insurance. So, an agribusiness will utilize life and health insurance coverage as part of their employee benefits. Basically, if you have full-time employees, you are obligated to offer them certain benefits, and one of those benefits is insurance, both life insurance and health insurance. So we'll talk more about what life and health insurance include. So health insurance might include dental insurance, vision insurance, and then also disability insurance. So if an incident were to happen, let's say you were to be injured on the job and that injury would render you unable to complete your duties on that job, that's where disability insurance would come into play. And then agribusinesses use property and casualty insurance to basically to protect their vehicles, their facilities, their buildings, and then things like that. So it's very important that whenever you are considering a an insurance policy, that you are very familiar with what that policy covers and what it does not cover. Prime example: many people, but if you own a home, you have to have property insurance to protect that home in the case of, let's say, the home catches on fire or it's damaged in a storm. However, if you actually read most home insurance or property insurance policies, they don't actually include flood insurance. Okay, so they will cover you if your house burns down or if your house is, damaged in a storm. But if, your house just gets flooded and damaged because of that, most property insurance policies will not cover that. They require you to purchase flood insurance separately from your property insurance. So, just a prime example of why it's very, very important that you read that insurance policy and understand what is covered, but just as importantly, what is not covered. So, let's talk about the different categories of insurance. Life insurance. Life insurance, the whole purpose of life insurance is not to protect you, because if you're utilizing your life insurance, you are deceased. It's to protect the beneficiary. And the term beneficiary refers to the designated, excuse me, the designated recipient of the benefits of an insurance policy. So, for example, if you are married, typically your beneficiary is going to be your spouse, meaning that if you were to die, uh, the life insurance policy, whatever the dictated amount of money in the policy is, that amount of money would be paid to your beneficiary. So, oftentimes when you take out a life insurance policy on yourself, they will ask you who the beneficiary is. And most people list their spouse or their children. And the whole purpose is to provide some source of income for your family if you were to pass away. The idea is if you have a life insurance policy, your family is dependent on you, dependent upon you earning money, and if you were to pass away, obviously you wouldn't be able to do that anymore. So life insurance is a way to provide them with at least some money after your death. So there's two basic types of life insurance, term and whole life. Term is life insurance purchased for a specific length of time at a fixed rate based on the age and health of the individual. So if I were to purchase a term life insurance policy, maybe it would cover 10 years, and I would only be able to uh, basically collect on that insurance if I were to die in a certain period of time. I would have to die within that 10-year period of time. Okay, so typically people will purchase term life insurance later in life. Just statistically speaking, you're more likely to pass away in your 70s, okay, than you are in your 30s. So term life insurance a lot of times is something people will purchase late in life. And then you have your whole life insurance, and whole life insurance does not have a term. It lasts your entire life. It's basically it covers you until you die, regardless of when that does occur. So with whole life insurance, you're going to pay a premium the entire time, regardless of changes in health or age. So as you pay premiums on that insurance policy, it actually builds up a cash value similar to, if you were making payments on a mortgage. Well, as you continue to pay on that mortgage, the more of that mortgage that you have paid off, um, basically you have equity in that home. You can actually use that equity to borrow against or to use as collateral on a loan. Well, you can actually use a whole life insurance policy as collateral if you have enough paid on it. Okay, so that is how whole life insurance works. Now, let's say you do that. Let's say that you use that insurance policy to take out a loan, use it as collateral to take out a loan to build onto your house. Okay, and you die before that loan is paid off. Basically, what they do is they subtract what you still owe to the bank from that life insurance payout, and your beneficiary would get the rest. The next type of insurance is health insurance. And the purpose of health insurance is to establish protection that provides payment of benefits for covered sickness or injury of the insured. So basically, it covers or helps you take care of your medical bills. So if you are a full-time employee for a business, that business by law has to offer you a group insurance plan. And the idea is that health insurance is a benefit because your group insurance plan is going to give you a cheaper premium and better protection than you could probably get if you were to seek insurance on your own. You can go get health insurance by yourself. Okay? You don't need your employer to do that. However, if you were to go get health insurance by yourself, your premiums are going to be extremely high. Your deductible is probably going to be extremely high. And it's just quite frankly not very good quality insurance. That's why group insurance plans are so important from your employer. And the idea is it's very closely related to the concept of a cooperative that we talked about in our last lesson. If you get a lot of individuals together, that gives you more bargaining power than if you were to try to negotiate on your own. And that's kind of how a group insurance plan is. An insurance company will offer better rates and better premiums to a company that has, 500 employees, let's say, because they know that they're getting a lot more business and they're more likely to negotiate with them because they're, uh, you know, working together as a group instead of just individuals. So, with your health insurance, it's impossible that you know what the exclusions are of that policy and also what it will cover and what it will not. Health insurance is not a one, one policy covers everything type of thing. Insurance companies will have different requirements in terms of what they will cover, what they won't. If they view something as an elective operation or an elective or something that's not necessary for health, they may or may not cover it. They also will maybe cover things that are preventative. Maybe they will pay for you to go get a yearly checkup because they view that as preventative. That if you go get that yearly checkup with a doctor, it may prevent a larger, more expensive health issue further down the line. So they're willing to cover that. Not always the case, but sometimes. They also will require you to go to oftentimes certain physicians. You don't get to always choose what doctor you go to. They will have what they call a network, and they may only offer coverage if it is quote unquote in network and is on their list of approved doctors. Workers' compensation is an insurance system requiring employers to cover employees for job related injuries. So basically, if you are injured or become sick on the job as a result of your work environment, your workers' compensation insurance will cover that. So employers will oftentimes have workers' compensation insurance because if, let's say, someone is injured on the job, they don't want to have to be responsible for paying what could be a pretty large sum of money. So workers' compensation insurance is something that comes in and covers that expense. And disability insurance is protection for the insured if he or she is unable to work because of a disabling injury or illness. So it will actually provide income for the insured for a specific period. Now, if the injury is temporary, uh, disability insurance works well because it provides income during the length of time it takes that individual to recover. But if it does indeed constitute, a permanent disability where the individual is unable to fulfill their duties of their job long term, then you need to basically you would have to apply for disability benefits from the government. You can actually get payouts. You can actually get money from the government for your disability. Okay, so that would be your long term source of income. The disability insurance is temporary though. Then we have vehicle insurance. Vehicle insurance is used to provide protection against the cost that may be incurred as a result of an auto accident, especially where the insured is at fault and a lawsuit could result. So, as long as we have cars, we're going to have car accidents. People are going to wreck. So, car insurance or vehicle insurance covers uh, the insured for both the damages that occur as well as medical bills as well that may arise as a result of a vehicle accident. So, basic coverage usually provides for property damage and liability. So, you can also elect for collision and comprehensive coverage on the insured vehicle uh, as well. So, business interruption insurance is designed to provide protection from loss of business income for a specific period of time if the business is destroyed and if it will take some time to relocate or rebuild. So if you own an agribusiness and let's say a tornado damages your business to the point where you can't fulfill your business activities or perform your business activities, that's where business interruption insurance would come into play and it would actually protect you from the lost income that would result from that business being unable to operate. Okay, we'll go ahead and stop there for right now. You have questions on Canvas to answer for your e-learning assignment. If you have any questions, as always, feel free to let me know. Thank you and have a great day.